You sign your name on the dotted line. The pen feels heavier than it should. The finance manager slides the final sheet across the desk. Monthly payment $734, loan term 68 months. That is nearly 6 years of payments before you own anything outright. You nod because you need the car. You need to get to work. That moment is happening right now in dealerships across the country. Millions of times over. Americans currently owe $1.64 trillion on car loans. Not student loans, car loans. That number is larger than the entire student debt load carried by every graduate and dropout in America combined. Let that sit for a second. And the cracks are showing. In October 2024, the Federal Reserve Bank of New York reported that auto loan delinquencies past 90 days reached 2.9%, the highest reading since 2010. Cox Automotive reported 60-day delinquencies hit 2.44%, up from 1.65% in 2021. These are not rounding errors. These are people losing their cars in suburban driveways before sunrise. The Federal Reserve's own Financial Stability Report, published in May 2024, put it plainly, auto loan delinquency rates have been rising, particularly for subprime borrowers, and are now above pre-pandemic levels. So here is the question this video is actually asking. If a car is not a luxury, if it is how you get to your job, your hospital, your kid's school, how did lending against it become a systemic risk that regulators are quietly watching with alarm? The answer involves a specific Federal Reserve dataset and a specific securitization delinquency number that, side by side, form a pattern this country has seen exactly once before. Because when you see what those two numbers reveal together, you will understand exactly who is holding the bag when this breaks. Here is the easy explanation. Car prices spiked during the pandemic. Interest rates rose to fight inflation. Consumers stretch their budgets, the squeeze is temporary. Prices fall, rates drop, problem solved. Case closed. Except the data does not close the case. It reopens it. Experience state of the automotive finance market. Fourth quarter 2024 shows average new car loan rates hit 9.8%, not 4%. Not 6%, 9.8%. That is a mortgage level rate on a depreciating asset that loses 15% of its value the moment it leaves the lot. The loan terms are stretching to match. Ivan Drury, Edmunds Director of Insights, reported average loan terms exceeding 68 months in 2024. Nearly 6 years of payments. On a car, buyers are underwater almost immediately, owing more than the vehicle is worth before the first oil change. But here is where the inflation story quietly collapses. The delinquency surge is not in new car loans. It is not hitting prime borrowers who bought a fresh sedan at a dealership last spring. Melinda Zabritsky at Experian tracked where the stress is actually concentrated. Used car subprime loans originated in 2021 and 2022. Those are the loans written at peak pandemic prices, when a 3-year-old pickup truck sold for more than its original sticker. Those vehicles have since lost 30, sometimes 40% of their wholesale value. The loan balance has not moved proportionally. The borrower still owes 2021 money on a 2024 car. That is not an inflation problem. That is a collateral problem. The collateral is gone, the debt remains. Delinquencies are climbing because there is no equity cushion left to absorb a single missed paycheck. So who actually holds these loans now? And what happens when the collateral underneath them keeps falling? Here is the part that changes everything. The bank that approved your loan almost certainly does not own it anymore. Within weeks of signing, that loan was bundled with thousands of others, repackaged into what Wall Street calls an asset-backed security, then sold to investors hungry for yield. Pension funds, insurance companies, money market funds. Accounts where ordinary people park retirement savings they cannot afford to lose. This is called the originate to distribute model. It has a structural flaw hiding in plain sight. When the lender sells the loan, the risk leaves with it. The fee stays. That fee is booked the moment the paperwork moves, before a single monthly payment arrives, before anyone knows whether the borrower can actually hold up their end. The lender has already been paid. In 2024, SIFMA, the Securities Industry and Financial Markets Association, reported that $181 billion in auto asset-backed securities was issued in a single year. That is not a niche corner of the market. That is a conveyor belt. The Consumer Financial Protection Bureau's 2023 supervisory report documented what was riding that belt. Subprime auto originators were routinely approving loans where the borrower's total debt exceeded 50% of their income. Half their paycheck gone before groceries. In August 2024, Fitch Ratings downgraded its outlook on the entire subprime auto ABS sector to negative, citing loss rates climbing faster than models had projected. The lenders who built those models had already collected their fees and moved on. So here is the question that keeps credit analysts awake at night. The risk has been distributed, spread across pension portfolios, insurance reserves, retirement accounts. That sounds like safety. But what happens when those securities start defaulting at scale and the losses land on people who never once set foot in a dealership? Here is the part that changes the story completely. The loans failing right now were not written last month. They were written in 2021 and 2022, when the Manheim Used Vehicle Value Index hit an all-time high of 236.3 in January 2022. Lenders approved those loans against inflated collateral. The cars were worth peak prices. The borrowers were stretched. Almost nobody flagged it. Then the tightening came. The Federal Reserve's 2024 Senior Loan Officer Opinion Survey shows 66% of banks tightened auto lending standards across 2023 and 2024. Stricter credit score minimums, lower loan-to-value limits. Shorter terms, the banks closed the door. But closing the door does not cancel the loans already inside. Those 2021 vintage loans had already been packaged, sliced and sold into asset-backed securities pools. The packaging happened fast, the due diligence happened fast. The assumptions baked into the models assumed used car prices would hold and default rates would stay manageable. Those assumptions are now colliding with reality at speed. Santander Consumer USA's 2024 annual filing shows net charge-off rates on subprime auto ABS tranches reaching levels that triggered early amortization clauses in several deals. Early amortization is the structural equivalent of a fire alarm. Losses are arriving faster than the deal was designed to absorb. Here's the mechanism that matters. Every ABS deal has layers. Subordinate tranches absorb losses first, protecting the senior layers above them. Pension funds and insurance companies were told the senior layers were safe. Investment grade protected. The subordinate tranches in several 2021 vintage deals have already been wiped to zero. That buffer is gone. The losses are now climbing toward the layers that retirement accounts own. The question is no longer whether this is a problem. The question is, who is actually holding it? And do they know yet? Here is the payoff you stayed for. The Federal Reserve's 2024 Senior Loan Officer Opinion Survey. The SLOOS shows that 66% of American banks tightened their auto lending standards between 2023 and 2024. Not loosened, tightened. That single number matters because it is not new. It is a pattern. The same survey showed identical tightening in mortgage lending between 2006 and 2007, 12 months before the housing market collapsed. Add the second number. Fitch Ratings reported that subprime auto asset-backed securities hit a 60-day delinquency rate of 6.11% in the fourth quarter of 2024. That is the highest reading since 1994. It exceeds the worst months of the 2008 financial crisis for this asset class. The securitization machine that packages your loan and sells it to pension funds is carrying losses that break 30-year records. Two numbers, same sequence, different asset class. Remember that receipt from the dealership? The one with the $734 monthly payment. That document did not stay in that building. It traveled, someone bundled it, rated it, and sold it into a security that a pension administrator somewhere is holding right now. Wondering why the loss column keeps growing? You can find out exactly where your loan went. Under the Truth in Lending Act, you have the right to request your servicer's identity in writing. One letter, the answer tells you which institution owns your debt today. Two documents tell you where this goes next. The Federal Reserve's quarterly SLOOS release. Fitch's monthly ABS delinquency report. Both are public, both are free. Both are the earliest warning system this market has. The car in your driveway is ordinary. The paper behind it is not. Subscribe, a new breakdown like this every day.